Alrighty. Good evening. Oh gosh, do I even need a mic? Or I do? Okay, cool. Oh, because you did the hard work of putting the label on. Okay, good evening. Thank you all for taking time off of the start of the week on Monday to spend some time learning a little bit about, hopefully, the startup ecosystem way outside of Krakow in Poland, all the way down in the tip of Africa. My name is Zack George. I'm one of the co-founders of Launch Africa Ventures, which is the leading venture capital fund on the African continent. Until about 2 months ago, I'm sure Adam and a lot of folks at the event in Warsaw that I spoke at didn't even know that Africa had venture capital. So I'm here to dispel a few myths and hopefully share a few war stories about building companies, investing in them, scaling them, and exiting them that some of you may relate to as either founders or investors. And I'll try and share a little bit about my own journey if possible. But the whole point of this is to just share some information about the state of private capital markets in Africa, and I'll leave enough time for Q&A. And if I'm too boring, just feel free to heckle me and ask me to stop. Before I get to sort of the gist of what I'm talking about, the reason I decided to move to Africa about 15 years ago, as you can tell, I'm not from Africa, but I've lived there for many years, is I had the privilege of going to Stanford University to get my MBA in 2004, so about 20 years ago. It gives away my age a little bit. But there was a professor called Randy Komisar, who was a partner at the time at Kleiner Perkins, one of the biggest Silicon Valley VC funds that funded companies like Facebook and Google, etc. And he said something in the class that completely shook the core of my being, even to this day. And he said, of all the risks in life, the biggest risk is the risk of not doing what you want on the bet that you can buy yourself the freedom and the time to do it later. And I'm sitting there, I was 21 years old, thinking, what the hell is he talking about? Like, what, buy myself time and freedom to do something later? And it's only much later in my early 30s that I realized that so many of us have incredible dreams and passions that we want to do, but we always say later, after I've saved up a few million, after I have the house, after I have the family, after the kids. And sometimes that after never comes, all right? So one of the reasons why I decided to move all the way from San Francisco to New York, the tip of Africa, was because I saw a huge opportunity in the innovation and tech ecosystem on a continent that most people completely ignore and forget. And I think a lot of entrepreneurs here in Poland and the sort of Central Eastern European ecosystem can relate to that as an ecosystem that's often forgotten. So let me give you a few hard, in fact, I'm going to start with some questions. So raise your hands if you know what the fastest growing continent in the world is from a population standpoint. I'm going to give you an easy question first. What is it? It's Africa? Yeah, that's an easy question. The second part of the question is, what do you think this is a question to you. What is the average or median age in Poland? Like the median age of the population? 44? 45? I don't know, you tell me, I'm asking you. Okay, and in Europe it's about 43. Maybe it's a bit higher in Poland, I don't know. What do you think the median age in Africa is?
90.
You've done your homework, I like that. It is 18. So Africa has 1.5 billion people, which is pretty crazy. It's the same as India and China individually, but the difference is the median age in Africa is only 18, and it's getting smaller. By 2050, the median age in Africa will be 15, according to the WHO. So that is either a glass half full or a glass half empty problem. So as the rest of Europe and even parts of North America are struggling with declining birth rates, you have an increasing dependency on a very young population demographic to cover the very old people and the very young people. Japan is literally a time bomb that's slowly exploding. Northern Europe, even parts of Central Europe. Africa and Asia, on the other hand, have the opposite problem. But it's a problem that is, in fact, an opportunity. So why is the high population growth? So by 2050, the curve where Asia is the world's fastest growing population is going to flip, and it's going to be Africa. In these next 30 years, 1 in 3 people on the planet born will be based in Africa. The question really is, who are we building all these tech platforms and products, goods and services for? One of the biggest reasons why Africa has been ignored for many, many, many years, if not centuries or decades, has been this concept of low consumer purchasing power. So with an increase in population, by the turn of this century, out of the 20 largest cities in the world, 12 out of the 20 will be in Africa. And it's cities that you may not necessarily expect. It's cities like Kinshasa, Lagos, Cairo, Johannesburg. And it's not just people, it's the purchasing power of these people. So my father was an economist for one of the largest central banks in the world, and he loves macro. So high population growth. What does it mean? You're having an increasing workforce that is able to change this concept of a net producer to a net consumer. Now, I'm not sure how many of you were sleeping in your economics classes years or decades ago, but the reality is economies that consume are economies that grow. Economies that just produce stagnate. You can see what's happening with Japan, you can see what's happening in many other countries in Europe. The second thing is urbanization. You're seeing an increasing percentage of people in Africa, in Asia, but specifically Africa, moving to the cities. And that increases economies of scale, increase in infrastructure and consumer spending. And probably the most important thing is connectivity. When I first came to Africa in 2010, so about 15 years ago, I came to watch the World Cup. That was my reason for coming to Africa. The Waka Waka Shakira World Cup, for those of you that have forgotten. The Vuvuzela World Cup. When I came to Africa then, I was an investment banker in New York City. I was at Lehman Brothers for many years as a banker. So those of you that remember the crisis of 2008. I came to Africa after spending almost 10 years on Wall Street as a banker and a trader. And there were more mobile phones in Manhattan, not New York, not the US, in Manhattan, than the whole of Africa. Right? That's crazy. Just think about it. Today, 15 years later, there are more mobile phone lines in Africa than the whole of North America. So just in 15 years, there's been a complete mobile revolution. And coupled with that is this concept of connectivity. It used to cost on average between $45 to $50 US dollars for 1 gigabyte of mobile data in Africa 15 years ago. So it was prohibitively expensive for anyone to be digitally, commercially active. Today, 15 years later, the average cost of 1 gigabyte of data across the 54 countries in Africa is less than $2. So you see this perfect storm for those of you that have the ability to think into the future. Growing population, high urbanization, very low cost of data, an increasing number of smartphones, and you see a continent like Africa that's always been a net producer to becoming a net consumer. What does that mean? For those of you that are either VCs, investors, or founders, it's higher consumer purchasing power. And that's one of the main reasons why I decided 15 years ago that I was done with banking and Silicon Valley and decided that I would focus on where will the returns be in 10 years, in 15 years. Those of you that have followed the tech ecosystems in Israel, in India, have noticed that. The Indian tech ecosystem, for example, 15 years ago, India had 0 unicorns. Today, India has more than 130 unicorns, which is literally only behind the US and China. So Africa is about a decade behind India, but is certainly on the rise, and it's something that very few people in Europe are even aware of. In the interest of time, I'll make these slides available, but these are just sort of putting into words what I've been talking about earlier, the fact that the working age population in Africa is growing quicker than any other region or continent in the world. And not just that, the size of this urbanization is what's driving increasing consumer spending. And I'm going to give you real examples of this in the slides to come. And what's crazy is the size of the digital economy in Africa is expected to grow by more than 6 times before or in the next 25 years. Now, I was talking to someone from the Krakow Economic Development? Put up here, there you are. We've spent the last 10 years analyzing the top tech ecosystems in the world. By show of hands, can someone give me the top 5 cities in the world from a tech innovation standpoint? You can just shout it out.
San Francisco.
Okay, yeah?
Singapore.
No,
London.
not Singapore. London, yes. Come on, we need a bit more activity. Bartender, could you refill their glasses? The audience is
London.
London, San Francisco, what else? Berlin?
Berlin.
Not Frankfurt, come on. Frankfurt's just a bunch of bankers and insurance brokers. No, there's nothing in Frankfurt.
Tel Aviv.
Tel Aviv, yes, yeah.
New York.
New York, ish.
Nothing in China.
Beijing, yeah, of course. Bangalore, Beijing, Berlin, Tel Aviv, London. So, have you ever wondered what makes a particular city a hotbed for innovation? So why do you have within the same country a city that has an incredible tech activity, startups, unicorns, founders, people in digital media, advertising, tech, UX, UI, all that great stuff, but a city in the same country with the same population a few hundred miles away has nothing? So why, for example, San Francisco? Why not New York? Why Tel Aviv? Why not Jerusalem? Why Berlin? Why not Frankfurt? And the reason is that innovation moves around ecosystems, not around countries. And it's a bit of a tempting question because I'm sort of hinting at why Krakow, not Warsaw. But here are some of the most important factors, and this is based on more than a decade of research, that determine what makes certain cities the perfect hotbeds for innovation. And on the backdrop of this, there are 4 cities in Africa that fit this criteria. One is Cape Town, where I live. If you haven't been, get a ticket. It's so fucking beautiful. Nairobi, Cairo, and Lagos. Now, first of all, you gotta have smart, talented developers, designers. But it's not just tech people, it's people that work within the tech ecosystem. So it's people in UX, it's UI, it's marketing, it's sales. And you have to create an environment, a quality of life that makes it conducive to attract talent, right? Secondly, and probably the most important, is this concept of risk capital. Not just capital, but risk capital. So it's the idea of, there are a few angel investors in the room here, it's the idea of what is your attitude towards money. Money has the same value to everyone, but it has a different meaning to different people. So there are certain cities in the world where people's attitude to risk is more capital preservation than capital creation. So you could have a very wealthy city like Tokyo or Monaco or Macau or Seoul in South Korea, with lots of money. But their attitude to capital is capital preservation, not capital creation. So they will have very little innovation. Whereas cities like San Francisco or Berlin, etc., the attitude to risk is how do we create wealth? How do we originate wealth? Not just how do we protect wealth. One of the highest GDP per capita cities, or one of the highest wealth per capita cities in the entire world is a small town called Stellenbosch, which is about 40 kilometers outside of Cape Town. It has an enormous amount of wealth, but the attitude towards risk is so terrible. So what's really important as you sit in the room here, if you're an investor or a founder, is are you building something and attracting the right attitude towards risk? And if you're not finding it in the city that you happen to live in, go somewhere else. All right? So the attitude to risk is super important. Number 3 is how do corporates work with startups? Now, in very mature ecosystems like Silicon Valley or London or possibly Shanghai/Beijing, you don't need, because there is a surplus of risk capital, you can afford to build B2C business models and expect that smart money will fund customer acquisition costs, even if your early cost of acquiring customers is high. I'm sure most of you get these terms. I'm not going to have to explain myself here, but if you can, ask me in the Q&A. In less mature ecosystems, you have to go down the B2B model or the B2B2C model because your LTV to CAC ratios are not, your customer acquisition costs are not easy to fund. Therefore, it is imperative that big insurance companies, retailers, telcos, super important telcos, and banks provide access to distribution. If you don't have that, you're going to spend a lot of money and time acquiring your first 100,000 users, depending what industry you're in, without getting to economies of scale. So in less mature markets, and I've found that this in Africa firsthand, working on startup corporate collaboration through the 4th point, accelerators, incubators, venture builders, co-working spaces, super important. But it's so critical to understand that corporates work with startups, not to invest in them, but to provide access to channel and customers. And these transactions are typically structured as either license agreements, royalty agreements, JVs, rev share agreements, and this is how smart founders can scale businesses without having to raise a lot of money and without having to spend a lot of time acquiring customers. And these are all factors that make certain cities hotbeds for innovation. So in these cities like San Francisco, in Tel Aviv, in Berlin, in Bangalore, the big corporates are very proactively involved in working with startups, not from an equity perspective, but from a POC, proof of concept, a pilot, and a scaling standpoint. Does that make sense, everyone? Okay, and the last but not least, this is where we could use some help from government, is in these cities, government is an enabler and does not roll out red tape, but has a red carpet and allows for things like R&D grants, tax subsidies for entrepreneurs. And government is basically an enabler that helps startup founders scale. So a combination of 3 to 4, and if possible 5 of these factors is what basically takes a city from an ecosystem that enables innovation to one that can thrive. So it's just important to keep this in mind when you look at the growth of the ecosystem here in Krakow. What's happened with venture capital in Africa for the last 10 years? Well, Africa really had no venture capital until about the year just before COVID. So when I first came to Africa in 2010, 2011, there was nothing. I was one of the few crazy people to start building the tech ecosystem when no one was doing anything there. Remember in 2013, the pivotal year when we started building venture builders in Africa, So think of Rocket Internet in Germany, but that applied to Africa. There was at best about $100 million of venture capital per year in Africa, which is the equivalent of 2 deals in San Francisco on a Tuesday morning. There was nothing. That was nothing. So Africa's real tech ecosystem took off in 2019. And today, if you factor in the sort of market correction last year, there's more than $5 billion of VC. Now that may seem like a good number, and it is, but compared to the GDP of Africa and the population in Africa, we suffer from what's called a double arbitrage. I'm a trader, so I have to use these numbers. Ex-trader, right? I left Wall Street a while ago. So Africa accounts for about 18% of the world's population, right? About 8% of the world's GDP, but only between 1.5% and 2% of the world's venture capital. So it's a question of when and not if that this arbitrage will slowly normalize. How many of you angels in the room or funds in the room have ever done investments outside of Europe, but specifically in Latin America and Southeast Asia? Anyone here that's done deals in Southeast Asia or Latin America? No? Okay, so Southeast Asia and Latin America are about 5 to 7 years ahead of Africa. But what's interesting is Southeast Asia, so people have heard of Grab, Gojek, these unicorn decacorns in Southeast Asia? No? Show of hands, has anyone heard of these companies? Yeah? Rappi, dLocal, yeah, sure. So Southeast Asia and Latin America's unicorns started, their unicorn factory, for those of you that love unicorns, started in around 2010, 2011. And Africa was about 5 to 6 years behind. Our first real tech company started growing in 2015. But what's interesting is if you factor into account this 5 to 7 year delay in the ecosystem taking off, we're actually tracking higher volumes of VC funding compared to Southeast Asia and Latin America. And again, people that look at global trends look at things like this. Has anyone here been to the African continent except for a holiday? If it's a holiday, put your hands down. No? Okay. So if you're intellectually curious, the markets in Africa that attract the most amount of innovation funding, Nigeria. Nigeria's population is almost half of Europe. Bet you didn't know that. Nigeria has 250 million people, not half, but a third to 40%. Kenya, South Africa, and Egypt, the 4 largest economies from a venture and innovation standpoint. But interestingly enough, North Africa, so Tunisia, Morocco, as well as Francophone Africa, French-speaking West Africa, which is Senegal, Cote d'Ivoire, etc., becoming an increasingly important part of the tech ecosystem in Africa. One of the things that I will mention later is the fact that the vast majority of tech startups in Africa have learned by virtue of accelerators like Y Combinator, Startup Bootcamp, Techstars, Plug and Play, that they house their IP in holdcos, holding companies, outside of Africa, typically in the UK, in the US, in the Netherlands, in France, sometimes in Luxembourg, or even places like Mauritius, which is part of Africa. But they set up very special holdco, opco structures where funding goes into the holding company where the IP is, so it protects investors' interests, but revenue, jobs, and taxes are paid at the opco level. And that's also why it's very easy to protect investors' interest with these structures. So if there are lawyers here in the house, that's an additional source of revenue for you. So you can talk to me at the bar later. Okay, I'm not sure, actually, but a question here. Where do the majority of Polish startups get their Series A and Series B funding from? It's a question, I don't know the answer.
Right now, probably bootstrap.
Well, bootstrap, but I mean, I'm talking about the Series A and Series B funds. Are most of the Polish startups backed by Polish VCs, or are they American or UK or, I don't know, Asian-based VCs?
Mixed.
Is it a mix?
C, Polish, Series A, Czech Republic, I would say, and US.
Czech Republic and the US, yeah. So an interesting, I always talk about reading the tea leaves, which is a phrase in English that says, see what's happening 4 or 5 years into the future. If you look at most mature tech ecosystems, outside of the US and maybe London, and China, of course, they always start off with foreign funds investing in their ecosystem because they have a much higher risk return trade-off. But eventually, as the ecosystem matures, you see a higher percentage of local funding into local startups. And it usually takes 5 to 7 years for the transition to happen. So if you look at the first tech startups in Africa, even the unicorns, the people that funded them were almost entirely North American and European VCs. Now, for the very first time last year, in fact 2 years ago, the percentage of Africa-based funds that were funding African startups flipped. And we actually beat North America. And that is usually the sign of a self-fulfilling, self-spiraling ecosystem. And these are things that I would encourage investors in Poland to also just keep track of. This is just a slide that talks about some of the $7 billion raised, some of the biggest $100 million rounds in Africa in the last 5 years. Again, I'll make these slides available after this. No prizes for guessing what sectors in Africa attract the most amount of funding. Fintech, by a country mile, attracts the most amount of funding in Africa. And that's primarily because, I wonder what it is in Poland. Is it fintech in Poland as well? Yeah, e-commerce, marketplaces?
B2B SaaS.
B2B SaaS, yeah. In Africa, the reason why fintech is the most dominant market is because the continent, to a large extent, from a payments perspective, is still driven by cash, which until recently was the same in Central and Eastern Europe as well. Digital payments are still a relatively new concept here, from what I understand, like less than 10 years old, right? So, and it's not just payments, it's lending. Less than 5% of African consumers have access to credit. Which is a reason why, for example, Amazon struggles to work in Africa, because Amazon's entire model is based on this dependence on credit, right? Lending, asset management, insurtech, payments, peer-to-peer, reverse factoring. So fintech is essentially the rails upon which other sectors like health tech, ed tech, e-commerce, clean tech are built on. I'll get to unicorns in a second, but the vast majority of $100 million plus companies in Africa started off as fintechs and later moved into embedded finance, super apps, etc., etc., etc. And that trend has no signs of stopping, right? For those of you that have paid attention up until now and want to know some numbers, in terms of valuations, one of the things about Africa that really attracts us and our LP base is the fact that because of perceptions alone, African tech startups at the seed stage suffer from this perception arbitrage, unfortunate situation where our valuations are significantly lower than the exact same businesses in other parts of the world. So a company, a B2B enterprise SaaS company selling to a big insurance company or a big telco doing $1 million in ARR in South Africa or Nigeria would trade at a 4 times ARR multiple, whereas the exact same company in Western Europe or the US would trade at a 15 times multiple, for example. So there's this big discount when it comes to seed and pre-seed rounds in Africa. There's a slight premium if you're in one of the big 4 economies, South Africa, Nigeria, Kenya, and Egypt, but it's still an average of $3 to $6 million pre-money. That's across pre-seed and seed, right? So when I talk, and these are all post-revenue companies doing up to $1 million in ARR, annual recurring revenue. What's interesting is as you get towards Series A, this arbitrage reduces. And at Series B, African tech startups trade at the same, if not higher valuations than their counterparts in the US, the UK, and China. Can anyone here think of why that's the case? Why does that normalization happen and in fact get better at Series B and Series C? Yeah.
My guess is that they are becoming international at that moment of time. That's it. And if they are already active in the United States or other countries, that's the reason why this normalization happens.
Yep. Buy that man a Bells. That's a joke in the US. Give him a Bells is, gosh, these US jokes aren't working. Perfect. Most African startups are solving real world problems with tech. So you're solving not nice to have problems, you're solving bleeding neck problems with tech. As a result, you're able to expand internationally to other African markets, to the Middle East, to Asia, to Europe, at Series B and Series C, where the stickiness of your revenue is so high that it becomes very difficult for consumers to switch. So the switching costs are very high. As a result, most African unicorns at Series B and Series C trade at higher multiples than American or European companies. But it takes a long time to get there. And one of the things that we're doing alongside other funds is to reduce the time it takes to get to Series B and Series C from what is currently now 10 to 12 years down to 5 to 6 years. So for people that see that in the future, that's what we're busy building. I'm guessing most of you recognize some of these names here. These are the global investors and their respective African investments just in the last 5 years. The list is much longer. But most of the big US and European funds, Sophia, Visa, Tencent, Accel, Insight, SoftBank, Khosla, DST, Time, all these big funds typically start investing in Africa at Series B and Series C. A few of the more sort of risk-taking funds will start coming into Africa at Series A. And this is important because who's providing deal flow to these mega funds in Africa? It's very few. Until about 5 years ago, the vast majority of funding into tech in Africa was from angels. People like yourself, but in Cairo, in Lagos, in Cape Town, in Nairobi, etc. But what we've done is now we've institutionalized seed funding, and we provide a perfect channel for liquidity. So we make our money at Series B and Series C, where we sell our stake in these companies through secondaries to bigger funds. And what's that doing? It's galvanizing this concept of recycling capital from founders who have exited, who have become angels, exit at Series B, and redeploy capital. And this is what Silicon Valley and China do so well. You cannot expect to be a fund that's only investing in Series B and Series C startups when they're de-risked if you're not feeding the pipeline. And this is essentially the story of how Southeast Asia and Latin America grew to where they are. And this is arguably what is happening in Poland and CEE and what's happening in Africa, right? This is probably the most cool slide to some people here, and this is how many of you, before I did this presentation, knew that Africa even had unicorns? You can be honest, you can raise your hand. You guys need, okay. The average time it takes to get to unicorn status, and by the way, this slide is as of the end of last year. There are now 2 more unicorns in Africa, so it's actually 16 right now. The average time it takes to get to $1 billion valuation in the US is between 8 to 10 years from inception, right? What's really interesting is the last few years in Africa, there are companies that have become unicorns in 3, 4, 5 years, spread across the continent. And the main reason why this is happening is my point earlier, is if you're solving real world problems in healthcare, education, payment infrastructure, climate, through technology, it's very hard to have customers go away and buy from someone else because your revenue is so sticky, you're solving real problems. When I was in Silicon Valley for many years, and I tell the story of how I was once pitched a startup that built drones to deliver organic smoothies from fruit juice stores on Market Street and deliver it via drones, and you'd have people with IoT devices opening your windows and delivering those juices and smoothies to your high-rise offices in San Francisco. And this startup raised more than $20 million. This is a classic example of an oversupply of capital solving nice-to-have problems. And this happens all the time in markets like the Valley in China, and even to a certain extent in some markets in Europe. The reason why you have unicorns happening, yes, it's a small sample size because we're a bit late to the party. But once a company solves a real world problem, it's very hard to go down from there, if that makes sense, right? By the way, we have a stake in 3 of these companies. Exits. Ultimately, I wouldn't say investing is easy, investing is bloody hard, but it's harder to exit. So where do most of the exits happen from an African tech ecosystem perspective? Well, flash news, similar to Central and Eastern Europe, the IPO market is non-existent to almost dead. Not a surprise. But the vast majority of exits happen through M&A. So to trade sales and large corporate buyouts. Corporates in Africa are extremely powerful. They borderline run like monopolies or oligopolies. So once you build something and you're past $10 to $15 million in ARR, a corporate is looking at you like a vulture or a hawk looking to acquire you. So just in the last 6 years, we've had more than 160 corporate M&A, mostly corporate M&A deals happen, which provides liquidity to obviously founders as well as early investors. One interesting fact before I sort of talk about what we do is there is this concept of vertical M&A where large corporates acquire startups, but most corporate M&A tends to be defensive. What does that mean? A large insurance company or a large financial services company acquires a fintech because they see some sort of a FOMO, afraid, what are they building that we can't do ourselves? Let me acqui-hire these founders so I can build it into our own corporate supply chain. So a lot of corporate M&A tends to be defensive, and as a result, the multiples that they pay of EBITDA, free cash flow, or revenue tend to be a lot smaller. However, the sign of a maturing ecosystem is when you see more horizontal M&A, which is larger startups buying smaller startups to get either geography, product, or economies of scale than corporate M&A. So you're seeing one of the biggest horizontal M&A deals in Africa was Stripe's acquisition of Paystack, one of the largest tech acquisitions in recent history. Okay, how many of you are still listening? Is this interesting? Yes, no, maybe?
Yes.
Okay, what do we do? We are one of the most active and prominent early stage VC funds in Africa. We've been around for just over 5 years. We call Launch Africa, it's a pretty simple name. Before Launch Africa, I used to run Startup Bootcamp in Africa. Startup Bootcamp, how many of you know what Startup Bootcamp is? It's the biggest accelerator in Europe. It's the accelerator that's created more unicorns than any other accelerator in Europe. So I used to run Startup Bootcamp in Africa. Launch Africa is the brainchild of myself and my co-founder Junaid, who's not here. In the last 5 years, we, across 2 funds, have deployed together with our LPs just over $60 million into 158 ventures. Our fund 1 is sitting at a 22% IRR. We've had 13 exits. But what's really interesting is this concept of, I mentioned earlier, this concept of focusing on liquidity and early returns to LPs as such an important requirement in less mature ecosystems. So if you're sitting as a fund manager in Silicon Valley or in Berlin, you can afford to sit on an asset for 9, 10, 12, 15 years because you know that the pool of potential unicorns is quite big. But in less mature ecosystems, you have to understand this concept of portfolio optimization. So a huge part of our exit strategy is through secondaries, trade sales, and doing partial exits in order to make sure that founders don't dilute as much as they should do. Oh yeah, my partner and I built this about 5 years ago. In the midst of COVID, we were looking to raise $10 million and we raised $36 million. So we were doing something right. And we were the first Africa fund ever to be featured on a Harvard Business School case study, which came out last month and is being discussed next week at Harvard. Our second fund, which we started raising about a year ago, is already sitting at an 88% IRR. We have 2 unicorns in that fund. But the reason I'm telling you all this is because there are so many misconceptions about Africa as a continent that is only deserving, if I may use that word, of aid, philanthropy, charity on one extreme, and the other extreme, mining, infrastructure, oil and gas, power, utilities, and basically extractive industries. The reality is what happens on the ground, if you live on the continent, is there are some incredible countries and companies spitting out not just unicorns, but companies that create sustainable, feasible growth through technology that are returning serious amounts of capital to investors that understand risk-return trade-offs, and we happen to be one of them. An example of our most recent unicorn is a company called Move. Has anyone heard of Move before? M-O-O-V-E. Moves, it's an African company based in Nigeria and South Africa, and they provide financing to Uber drivers and Bolt drivers all over the world. Most Uber and Bolt drivers and just ride-hailing companies, the people that drive these cars don't own them, right? So that doesn't really help you from a wealth creation standpoint. So Move provides financing, and they make sure that these loans have almost 0 default rates because, why? Because they can track the payment of these loans back from the commissions that are made by the ride-hailing company. So they have a complete line of sight into where the money flows. Their Series C, which is currently a week away from closing, was backed by Mubadala, the largest sovereign wealth fund in Abu Dhabi, Uber themselves, and BlackRock. Again, you don't hear of this in the news, but these are some of the really cool success stories here. I'm going to skip through all of this because this is boring stuff, but this is what emerging market VC funds look like. Just in 4 years, almost 2/3 of our companies have raised follow-on rounds at higher valuations. And our failure rate is just 16%, which if you're a fund manager or an angel, and your failure rate of your portfolio is anything less than 30% or 40%, you're winning. And the reason we can do this in a market like Africa is, again, what I said earlier, it's about African entrepreneurs building things that solve real problems. And it's very hard for a business to fail if you're building sticky revenue. I'm going to stop here because not everyone here is aware of what's happening on the continent, and I'd rather save it for Q&A. But the one thing I want to mention here is, for those of you that actually do care about impact, in the last 5 years alone, our companies have created more than 60,000 jobs. Something that governments and large corporates cannot even get close to this number. And we've deployed just under $50 million. So if $50 million of capital can create even close to 60,000 jobs, and you know of any entity that can do that, please talk to me, because I'd love to be proven wrong. And from a female founding perspective, 20% of our companies are run by women. The global average is about 2%. So for those of you that do track metrics like this, it's important to know what happens from an impact perspective. And like I mentioned earlier, it's very important, if you're a fund manager trying to invest in companies, that you have to understand the importance of early liquidity from a returns to investor perspective than just hoping for unicorns. I'm going to stop here. If you have any questions, I'm here for the whole evening, but if you have questions right now that you want to ask me about anything, the state of tech in Africa, returns, VCs, most of our investors in our fund are ordinary people like you and I. Until very recently, it was almost impossible for anyone to invest in VC funds because you had to be an HNI, you had to be an accredited investor. In a fund like us, we're a US dollar fund. All our portfolio companies are domiciled in the US, in the UK, the Netherlands, in France, in Germany, etc. And we allow people to invest as little as $50,000 and get the opportunity to co-invest with us at the same terms without any fees or any carry, which is something that I'm hoping is a model that's adopted here in Poland as well. Because one of the biggest inhibitors for angel investing is this concept of investing in funds but being double charged for co-investments through SPVs. And as an investor, you want to have as little bottlenecks as possible to invest in the growth of your own ecosystem. And that's something we strongly believe Africa needs. And we see so many similarities between the African tech ecosystem and what you see in Central and Eastern Europe. So if this is of any interest to anyone here, founders, investors that are intellectually curious about tech in Africa, that want to invest, that want to participate, that want to expand into Africa. There are founders here that are looking for Africa as a natural next expansion market, or people in Africa that want to expand to Central and Eastern Europe. Talk to me. I've been doing this most of the last 15 years. We're here to help. We're here to share success stories, good stories, bad stories, ugly stories. But ultimately, I want to see a bigger collaboration between two huge markets, Sub-Saharan Africa, and North Africa, and Eastern Europe. And I hope an opportunity like this creates this conversation where we start talking about the possibility of working together. So thank you all for listening. And That was a bit long, yeah?
Yeah.
Okay, questions. I mean, I'm here the whole evening, but if anyone has any burning questions that they want to ask, I'm here to take them. Yep.
1, 2, 3. All right, thank you, Zach. So I think we need more international expertise like Zach in our ecosystem. So that's really one of the things that the foundation is going to try to do, but we need help. But yes, who has a question? I'll walk around. So I will come to you. Please just say your name, maybe a bit about your profile, and a brief question.
Yeah, right there, yeah. I'll take
Just
both.
a quick question out of curiosity. Great presentation, thank you so much. Just out of curiosity, just a guy who wants to invest in...
Elvis Presley from Graceland, yes.
I have a question. In your fund, do you use any hedging a mechanism to mitigate FX risks, given the high volatility of local currencies? Like I think ZAR is like 10-15% volatile annually, like Ghana is like 20-30%, so do you have any mechanism? Thank you.
Yeah, it's a classic question that people often ask us, and then they invest with us and they realize that it isn't really an issue. So FX volatility is very relevant if you're in the private equity space. You're dealing with companies where the majority of your revenue is in local currency, which is why I mentioned earlier we have an insistence that our holding companies have to be in the US, in the UK, in the Netherlands, in Germany, etc. So all our opcos are in Africa. The opcos and holdcos have either royalty agreements, license agreements, or rev share agreements. When we exit, we always exit to later funds. So most of our exits are to Index, Axel, Lakestar, Bessemer, SoftBank, and ours is a dollar fund. So it's dollars in, dollars out. At the most, it's euros or pounds in and euros and pounds out. So we benefit from, I wouldn't say we have zero FX risk, but we have very little FX risk because our risk is only at the holding company level. Secondly, most of our investments are B2B, SaaS companies. So even companies that are in Nigeria, for example, that are providing, let's say, invoice discounting solutions to large banks, for example, the subscription revenue is in dollars, even though the bank is physically in Ghana or Nigeria. So that's the way in which we hedge a lot of our risk. You can't do that once you're at Series C and Series D, because then your opco tends to be very large and your acquisition opportunities are at the opco level, not the holding company level. But because we come in at pre-seed and seed and we're getting out at Series A, B, and C, we benefit from, I think you know where I'm going with this, right? So we're in quite a unique position that other funds don't have. But I mean, we've done 13 exits so far and we've had literally zero FX risk on those 13 companies. But very good question, yeah.
I'm curious, because Africa is a really diverse region, obviously. How do you handle the due diligence when there's such different economies across the whole thing, we're talking the whole continent?
Yeah, so we are a team of 18 people. We're one of the few funds where the vast majority of our staff are physically on the continent. So we've got folks in Mauritius, in Cape Town, Joburg, Nairobi, Accra, Abidjan, Cairo, you name it. I'm going to let out a lot of secrets here, so just keep it in this room. From day one, we insisted that our LPs, our limited partners, were mostly retail. So most of our LPs are ex-founders, a few unicorn founders. There's C-suite executives at big banks, insurance companies, and telcos across the world. There's CBCs, the second largest bank in Germany, Commerzbank, is an LP in our fund through Commerz Ventures. A lot of, I'm not going to mention her name, but the former head of PwC for the whole of Central and Eastern Europe is an LP in our fund. We've got lots of very powerful individual and family office LPs with good links to industry across the world. And they aren't LPs just for the money. They want to add a lot of network, resources, and mentorship linkages. And they don't have to work for us. But they want to help us because it helps the fund. So for example, one of our most prominent LPs is the former CEO of T. Rowe Price in the US, one of the biggest asset managers in the world. And he has links to the SEC, I mean, you name it. So we have two companies in our fund. One is a company called Trove in Nigeria that is literally a copycat of Robinhood, but in Nigeria. Another company called AfriX that uses stable coins for remittances globally. Now, all of this requires serious amount of regulatory influence that founders themselves, they're just founders, they focus on building product. But one phone call from this LP and things get done. He doesn't work for us. So we leverage our LP network. Most VC funds in emerging markets have DFIs as their LPs, which is IFC, World Bank, FMO, DEG, KFW. I mean, you guys know these institutions, right? While they give a lot of money, they add very little non-financial value. We went the opposite route. We said, we don't want your money. We like you. We don't want your money. We want money from strategic individuals. So our LPs help us with a lot of DD, post-investment support, and we have partnerships with the leading accelerators in the world. So we have, if you look at Y Combinator, Techstars, Plug and Play, Startup Bootcamp, their KPIs are who's funding our companies post-demo day. And it's mostly angels. The moment you have a fund that backs companies at demo day, they will make sure that they get you the best deals that have their tech squeaky clean, so AWS and Google certified, etc., etc. So a lot of the legal and tech DD is done for us on behalf of the accelerators. Our LPs help us with mentorship, resources, and distribution. The third part is our corporate network. So because we know the largest banks, insurance companies, telcos, and retailers on the continent, we make sure that once we back a company, there is at least a 2 to 3 year line of sight from a pilot or POC perspective. So a combination of all of this is how we sort of ensure that we have low failure rates, if that helps. And we have 18 people on our team. But what we do is not easy. It's not for sissies. Just open card. But yeah, it's a very good question.
Go ahead, question here.
Philip, I'm a founder, so thank you for your presentation, and also I think that Africa is like a huge continent with, as the previous person said, with a very diverse market. Let's imagine that I want to reach out to companies in Africa to like learn, to try to bring the product there. First thing, how to pick like the initial market, because those are very different countries with different cultures, and two, are there any like places where you would recommend me, for example, to search, for example, or like some kind of a bridge, organizations or websites, or where to start this process from this big strategic thing to like the real action?
Yeah. What industry are you in, just so I can give you like concrete advice?
B2B SaaS, of course. Yeah.
Of course, okay. But boring is good. Boring is what makes you money. So first of all, I would start. So what's interesting about Africa, and I've learned this the hard way, I've been in Africa for 15 years now, is Africa, even though it's 54 countries, has only three common law systems. There's English common law, French law, and Sharia law, right? It is easier to scale a startup in Africa than it is to scale a startup in Europe, right? This is not obvious. But once you see it, it becomes obvious, right? You look at companies like N26 in Germany, right? They're still only in the DACH region. You look at Adyen in the Netherlands. It's still just the Benelux. It's very hard to expand pan-European because of languages, legal systems. It's a shit show. In Africa, you can expand into any English-speaking country in Africa that uses British common law, which is basically 30 of the 54 countries. And if you're in a francophone country like Cote d'Ivoire or Tunisia or Morocco or Senegal, it's the same, right? So depending on what your target market is, that's one avenue, is to figure out what the common law system is. But secondly, you want to look at economies that have high populations, so it's high consumer purchasing power, that have very strong corporate distribution. So you want to look at what are the countries that have very strong telcos? Telcos are extremely powerful in Africa, much more than banks. Most of you have heard of M-Pesa. Have you heard of M-Pesa here? M-P-E-S-N? Yeah, M-Pesa is basically mobile banking through your phone, which is a foreign concept to a lot of people in Europe and the US. But it is literally the bloodline of money transfers in Africa. In fact, Mark Zuckerberg's biggest ambition is to buy M-Pesa, but it's not for sale. They just won't sell it. So if you want to expand to Africa, it's very important for you to understand, how do I add value to a telco? And the big telcos in Africa are MTN, Vodacom, Orange, which is French, that's being Africa, Vodacom, Airtel, MTN Orange, and then in North Africa, it's Etisalat and Orascom. Now, if you can provide a solution, enterprise SaaS, where you can make things faster, quicker, cheaper, and more efficient for the customers of telcos, you've got into Africa. Because what they care about is value-added services. The telcos will never invest in your company, but they'll partner with you and they'll take money from VC funds like us. So if you can think around solutions that can benefit telcos and financial intermediaries in Africa, that's a great starting point. Number two is you have to go and work with the accelerators, like the Y Combinators and the Techstars, and even the regional ones, because they are funded by the telcos and the banks and the insurers. So they're providing access to investors, access to AWS, Google, Salesforce, GitHub, all the big tech partners. So there are a couple of avenues. I'm happy to chat to you offline, but there is a method to the madness. There are some companies in I'm not sure about Poland, but in Western Europe that have cracked the Africa code, and then it's the gift that keeps on giving. Because revenue in Africa is a lot stickier than revenue in Europe, all things being equal, right? So there's a company, for example, in Warsaw that I spoke to 2 months ago called WeSub that does subscription as a service for rental goods. So sports equipment, laptops, phones, etc. Apparently doing quite well. And there's a similar company in Africa, in South Africa, doing the exact same thing. So it's a retail marketplace for second-hand consumer electronics. And they hadn't heard about a similar business in Africa. I now introduced them to them, and now they're looking at working together. So there is an opportunity for entrepreneurs in Central and Eastern Europe to work with Africa, and part of it is to, hoping that these connections happen. So.
Maybe one more? Zach's had a long day.
Yeah. But I'm around the rest of the evening to have questions.
One last one from the back.
I have an...
And just by the way, my email, I don't know, somewhere here was in one of the slides, but if you want to get a hold of me, maybe just go back a couple of slides.
Yeah, on the last slide.
Was it the last slide? Oh wait, hold on, where was it?
We changed the...
Did you? Okay.
Yeah, I'll go there.
Oh, we're back?
Yes.
You got it? Just take a picture of this. Oh, by the way, I think Paul will send these to everyone. So if you, my email is just Zach, Z-A-C-H, at launchafrica.vc, and that's my WhatsApp. Yeah, gentleman at the back, yeah.
Yes, thank you.
Sure.
My name is Jeroen Vossaert, which means a name probably nobody in this audience can pronounce because I'm not Polish. I'm actually Belgian.
Okay.
I come from Ghent, a city...
I was literally in Ghent 4 days ago. You have the most beautiful cathedral. The Ghent altarpiece. I saw it 4 days ago. Beautiful city.
It's a must-see.
Yeah.
It's also, according to Deal Room, one of the top 20 cities right now, startup-wise.
Yeah.
But I lived there 20 years ago.
Okay.
At the moment that we were looking, when a foreigner was coming to Ghent to talk about VC investments, we were like, oh wow, finally we're being noticed. Today we're top 20. How did that happen? Along the lines as you just described. So my question to you is, what brings you to Poland? What is the perception of Poland in the VC world abroad? Because I'm living too long here to still have the outside-in view.
Yeah. Yeah, listen, I was actually in Poland 2 months ago. Adam Weber here. Oh, by the way, a big round of applause to Adam for getting me here. For those of you that don't know, a little plug, Adam is the founder of a startup called ProMelody, one of the top, how would you describe it, a music tech startup. Yeah, promelody.com. Look it up. I have to put a plug to my friend here who brought me here. But Poland, why am I here? There was an article in Business Insider written about a month ago that talked about the similarities between the startup ecosystems in the sort of post-communist era companies in Eastern Europe, so Slovakia, the Czech Republic, Poland, etc., and Africa post-colonialism. And you'd be amazed at the similarities. So without getting too political, a lot of the founders in Africa post-colonialism had never gone to university. It took 1 or 2 generations for the children of these African, families to go to college. So when you graduate from university, the first thing you're thinking about is, how do I work for the government, the civil servant, or how do I work for a corporate and pay back my grandparents, uncles, aunts, families, etc. So it's only about a generation ago that people would start looking at the idea of taking risk and starting companies. The same thing, from what I understand, happened in Eastern Europe after the fall of communism. So running a startup was not the obvious choice in the 1990s. In fact, if you said, what are you doing after university? I'm running a startup, you'd be the laughing stock of your family, correct? Yes? No? Come on, give me some love. I'm speaking the truth here, I think. So there are a lot of similarities between Africa, colonialism, and communism, Eastern Europe. So there's been a lot of intellectual debate about, because founders in these two very different ecosystems have a lot in common that they don't know about, because ultimately running a startup is about consumer psychology and borderline behavioral economics. So I've been in Eastern Europe to understand what makes founders in Eastern Europe want to start companies. And ultimately, when you talk to VCs and angels and later stage funds, it's about how you tell your story. When you're raising a seed round or a pre-seed round, no one cares about your 5-year EBITDA because it's bullshit. It makes no sense, right? It's just a projection. But why do you build something is what eventually gets you not just capital and runway, but also contracts. So part of my time here is to see, what are the attitudes of founders in Poland, but also what are the attitudes of investors in Poland. There are quite a few African, I'm an active angel investor in African tech, but I also angel invest occasionally in businesses outside of Africa, in Latin America and Southeast Asia. I'm actually an LP myself in a small Eastern European fund, and I'm very good friends with the founders of Kaya VC in Prague. So I'm here to sort of fact find to see if there are ways in which angels in Africa can invest in funds and companies in Europe and vice versa. So that's the short answer in that sense.